Welcome to vTalkInsight, Market Drivers Daily for June 12, 2026. The largest IPO in history is hitting the tape. AI remains the core macro driver, and headlines from the Middle East are swinging oil and rates. Let's unpack how this mix of record equity supply, AI infrastructure spending, and shifting geopolitical risk is repricing key assets. The starting point today is the SpaceX IPO, a listing that is unprecedented in both size and complexity. The deal raised around $75 billion at a valuation in the low trillions, instantly placing the company among the world's largest by market capitalization. Demand was extraordinary, with total orders reportedly exceeding $350 billion and the book multiple times oversubscribed. Shares are indicated to open well above the $135 issue price, with gray and pre-market indications clustering around a 20 to 35% first-day pop, signaling intense risk appetite despite valuation concerns. What makes this IPO structurally different is who owns it and how it trades. Roughly one-fifth of the deal went to retail, with individual investors reportedly putting in over $100 billion of orders, far more than typical for a mega-cap listing. At the same time, Elon Musk will retain around 84 to 85% of voting control, reinforced by a shift of incorporation to Texas and arbitration provisions that limit shareholder recourse. Index providers plan rapid inclusion into major benchmarks, such as the Nasdaq, which in turn forces passive funds and ETFs to buy, amplifying early demand and potentially dampening the impact of profit-taking in the first phase of trading. Beneath the excitement sits a difficult valuation debate. The IPO is priced at revenue multiples north of 90 times, far above established hyperscalers, and much of the underlying value is already captured in private markets as the company's notional worth climbed toward $2 trillion before listing. Historical patterns show that while most large U.S. tech IPOs close higher on day one, a sizable share trade below issue price a year later, and mega deals often deliver flat performance versus the market over 3 years. Overlay that with a staggered lockup, significant expected debt issuance, and forecast cash burn in the tens of billions per year, and it is clear that small changes in growth assumptions or execution can have an outsized effect on long-term returns. This single transaction is also moving the rest of the market. There are signs of rotation out of cryptocurrencies and smaller, more speculative space names as investors make room for the new listing, with some peers already selling off on a classic sell-the-news pattern. At the same time, record inflows into cash and equities and strong passive buying suggest that the overall system can still absorb the new supply without immediate dislocation. The success of this deal is being watched as a barometer for the broader pipeline, including potential offerings from Anthropic and OpenAI, but there is skepticism that SpaceX's unusual structure, governance, and scale can be easily replicated across other issuers. Looking ahead, the key watch points are trading stability after the initial pop, the behavior of new leveraged and inverse products tied to the stock, and how space and innovation peers trade relative to this new benchmark. If SpaceX settles into a leadership role, it may become a proxy for a wider innovation complex in the way NVIDIA has for core AI, reinforcing the link between IPO flows and broader tech risk appetite. If, instead, early volatility is extreme or the stock struggles once lockups expire, that could chill sentiment toward the rest of the AI and tech IPO calendar. Either way, the narrative around this listing is already shifting from rockets to AI infrastructure, which is a natural bridge into the wider AI theme, driving macro and micro dynamics. AI remains the central equity and macro story, but the lens is evolving from pure growth excitement to capital intensity, inflation, and sustainability. After focusing earlier this week on the sheer scale of planned data center and power buildouts, today's developments underscore how AI and equity issuance are merging, with SpaceX recasting itself as a vertically integrated AI infrastructure platform rather than just a launch and connectivity business. Recent strategic moves, including hyperscale compute deals and acquisitions aimed at building frontier labs, highlight the ambition to capture multiple innovation-driven verticals from orbit to cloud. On the numbers side, AI infrastructure spending is projected in the hundreds of billions this year and even higher next year, a capex boom already larger than the late 1990s technology build-out. Hyperscalers have ramped up bond issuance to finance this wave, yet credit spreads remain tight, indicating continued fixed income demand for AI-linked names. Semiconductor stocks have seen double-digit percentage gains in a single session. Earnings revisions for chipmakers and Nasdaq heavyweights are running strongly positive, and upgrades such as the recent positive call on AMD point to confidence in incremental AI-driven demand. At the same time, GPU shortages and higher token and compute costs are feeding into producer prices, adding an AI-specific layer to the inflation picture. The counterpoint is that AI valuations are increasingly built on long-dated assumptions rather than current cash flows. For SpaceX and other AI-exposed listings, bulls anchor trillion-dollar values to projected operating income from connectivity and enterprise AI segments years out, while bears question whether orbital data centers can overcome cooling and hardware failure hurdles at commercial scale. Independent scenario work highlights that only a small fraction of cases deliver outcomes consistent with the most optimistic price targets, and partnership agreements can often be exited on short notice, limiting revenue visibility. That leaves a wide distribution of possible outcomes and raises the risk that even small disappointments on launches, AI workloads, or pricing could trigger sharp multiple compression. Beyond markets, AI is influencing labor and policy discussions in ways that feed back into macro conditions. Adoption is accelerating, with applications like ChatGPT reaching 1 billion users and AI-enabled drug discovery compressing development timelines from years to well under 2, while longevity and automation tools may keep older workers in the labor force longer. Governments, meanwhile, are racing to define AI policy, with upcoming G7 and central bank meetings expected to focus on how technology and energy interact in the inflation outlook. For portfolios, the near-term mix is powerful earnings support for core AI infrastructure names, high valuations, and a policy backdrop that may stay tighter for longer if AI-related price pressures persist. Those dynamics set the stage for the third driver today, whether an easing in energy tensions can offset some of that inflation impulse. Geopolitics and energy remain the other major axis for markets, with U.S. Iran negotiations at the center. Reports of a prospective memorandum to reopen the Strait of Hormuz, lift some oil sanctions, and unblock tens of billions in Iranian assets have driven a sharp pullback in crude. Brent has fallen from peaks above $125 to below $90, with some prints closer to $80, while European gas futures are down more than 7% on the day. Global equities, especially in Asia and Europe, have responded with a risk-on tone, as benchmarks like MSCI Asia rally in sectors such as airlines and leisure outperform on the prospect of lower fuel costs. The flip side of lower oil has been pressure on energy equities. European oil majors are down around 3%. The regional energy sector is underperforming, and long-dated oil and gas contracts have sold off by 4% or more, signaling an unwind of some of the embedded risk premium. Safe haven demand has also eased, with long bond yields dropping, including an 8 basis point fall in the U.S. 30-year, consistent with improved risk appetite and less fear of an immediate supply shock. Compared with earlier this week, when the focus was on triple-digit crude as a threat to the cycle, today's price action points to a market that is more willing to price a de-escalation scenario. However, the physical and political backdrop argues against complacency. Iran has not confirmed a final deal and appears reluctant to restore pre-conflict export volumes, while clearing mines in the Strait could take months even if an agreement is signed quickly. Storage at Cushing is running well below its 5-year average, and refined products such as jet fuel and diesel in parts of Europe are trading at extremely high levels, indicating ongoing tightness. Asian energy importers, including India and Indonesia, are still facing currency pressure and have resorted to tools ranging from rate hikes to capital inflow incentives, showing how energy shocks can force divergent policy paths across emerging markets. For central banks, the interaction between energy, AI-driven inflation, and growth is critical. ECB officials have signaled that another rate hike as soon as July remains on the table if energy and conflict-related inflation pressures persist, while markets expect the Federal Reserve to dial back any easing bias given elevated price risks. Gold continues to serve as a hedge for some actors against both inflation and financial system shifts, even if day-to-day pricing can be volatile as energy headlines swing. From here, Markets are likely to react less to rhetoric and more to concrete milestones. Any signed U.S. Iran agreement, evidence that flows through the Strait of Hormuz are normalizing, and how quickly gasoline and diesel prices respond. Those outcomes will determine whether the supportive impact of lower oil can offset some of the inflation impulse coming from AI capex and keep the current risk-on phase intact. To wrap up, a record-setting SpaceX IPO is drawing in hundreds of billions of dollars of demand, testing how much new equity supply global markets can absorb while reshaping sector leadership and volatility patterns. At the same time, AI remains the dominant macro and earnings driver, with massive infrastructure spending boosting select tech names, but also adding to inflation and valuation risks. And in the background, shifting U.S. Iran dynamics are pulling oil lower for now, easing some pressure on growth even as the underlying energy system remains tight and policymakers keep a higher-for-longer stance on the table. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.